Well, good morning, traders and investors. Roger Scott here, senior strategist for WealthPress. Today's Thursday. It's April 13th. April is almost halfway behind us. I remember April 1st. I was thinking about jokes to say here, but it was the weekend. Messed that all up. I get no respect. Anyways, folks, it's about 7:33 in the morning. The market's going to gear up to open in slightly less than half an hour. I'm trying to get up earlier so I can get these videos out to you earlier so you can have something to work with before the market opens. And by the way, subscribe to our Telegram channel. With the link to the Telegram channel is in the YouTube WealthPress channel below this video, and are all the links that you need regarding everything I'm talking about. Now, let me tell you why you should subscribe to the Telegram channel. Because yesterday we had a CPI report, and I came out with a video before the CPI report, but I had a few things to say after the CPI report, and I posted it on the Telegram channel, and over 1,700 people read it. Now, let me tell you what I wrote in my Telegram channel. Yesterday, we had the CPI report, and after the CPI report came out, the headline number was better than expected. See, look, they were expecting 5.2. They came in at 5. The market pre-open rallied hard. But when I looked at the ex-food and energy, the core, and the expectation was 5.6, and last time was 5.5, and I saw it was 5.6. I said, uh-oh, danger zone. This is what the Fed looks at. They look at the core CPI, and the core CPI was not pretty, and guess what happened yesterday? The bond market went down, which means higher rates. Fed started talking about regaining their inflationary pressure cooker, and the market didn't do so hot. But it was because of the core CPI. But if you weren't in my Telegram channel, you would have never gotten it. So subscribe to the Telegram channel, like our YouTube channel, watch these videos, and post comments. Now, that's the CPI, and we were dead right. Now, today we've got the PPI and jobless claims. Jobless claims is going to be a nothing burger. It's going to be 220,000, 230, 210. It's been straight up. But we have the PPI. The PPI. And let's see what the PPI says. I don't know what the ex-food and energy expectations is, but, and I don't even know what the consensus on a year, here it is, month over month. They don't even have it here. But here's what I need to tell you. Ex-food, energy, and trade services is 4.4. I'm hoping the number is going to be below 4.4 here and below 4.6 here. Now, it's not, the PPI is not nearly as important as the CPI, but this will also confirm or maybe put some doubt into whether the economy is slowing down, the inflation is slowing down or not. Yesterday's report showed us that the core CPI is getting higher, which means the Fed is being less effective, which means there's a much higher chance of a 0.25 basis point rate hike. Now, that's coming out in about an hour and in about 54 minutes from now. So make sure you watch this report, and as you watch this report, keep your eye on the bond market. And as you can see here, the long bond, which closed yesterday down 11 ticks, it's already down 21 ticks. I mean, it's not going directionally crazy right now, but it's moving lower. And if this moves lower, interest rates move higher. And if interest rates move higher, sectors like technology, let me just, for example, they don't do so well. So Nasdaq yesterday was in the crapper. Now, it looks a little higher this morning, but again, the trend has been going down since it made this peak right here. And we can either go sideways or we can continue moving lower. But I'm telling you right now, I'm not seeing anything crazy bullish right now. I'm not seeing anything bullish. Best case scenario, choppiness. Worst case scenario, further downside. Notice, though, what's interesting is, look at the technology sector. It's cooling off. Look at the QQQ. Because remember, the QQQ, it's cooling off a little less, but it's still cooling off. You can see this trend is coming down right here. Look at the S&P 500. Chop sideways, doesn't have that technology exposure, more sideways. Look at the Dow. Let me go 1 month. Higher, actually, higher, not lower. So there's a lot more strength in blue chips now because interest rates don't have as much vulnerability to rising rates as technology and communication services. Basically, these sectors that have been cooling off right here, look at communication services had a big bar, look at technology had a big bar, and consumer discretionary, which we will find in a second, right there, had a big bar down. And notice it's going lower. Technology sector is starting to go lower. Communication services is kind of choppy, doesn't have a lot of directional bias, and it didn't take out the recent high. So those are really, really vulnerable right now. Now let's talk a little bit about the report, that's the data today and what to expect, and confirmation from yesterday. And then we'll move on to the best sector, best option for today, because today's Thursday, and Thursday I'm always giving you my top ETF and option pick. So U.S. benchmark indices ended the regular session in the red, as I warned you yesterday. Why? Because market participants weighted recession risk following the minutes of the Fed's policy meeting, and also CPI report. They're forgetting to say that. The minutes of the Federal Committee meeting showed the Federal Reserve policy makers debated between keeping its rates unchanged or hiking it by another 0.25. At the same time, Fed officials feared that the fallout from the U.S. banking crisis could tilt the economy into a mild recession later in the year, the minutes showed. I don't think that's going to happen. I don't think the banking crisis will do it. I think we may have a mild recession, but I don't think the banking crisis is going to cause anything. Core CPI, the measure that the Fed economists expected the growth was 5.2%. It was actually, it came out better. Now, core CPI, which excludes food and fuel prices, rose 5.6%. Higher than 5.5% increase in volatility. This right here was the main driver. This thing in yellow, that was the main driver yesterday, not the minutes. Currently, or after the release of the CPI, the 0.25 is now baked in at 66.8%. Honestly, I thought after that nasty core CPI, it would be worse. But remember, the regular CPI was not as bad. So anyhow, they're still giving it 66. I think if today's PPI is bad, this will start moving into the 70th percentile. Meanwhile, San Francisco Mary Daly said Wednesday that the Federal Reserve might have to tighten policy further due to still high inflation and strong economy. Do you need a clear picture that we're going 0.25? While the full impact of this policy tightening is still making its way through the system, the strength of the economy and the elevated readings on inflation suggest there's more work to do. I don't know how anyone can be clearer than that, honestly. Now, compare that to what Mr. Squirrely, A.K. Powell, says. U.S. core PPI reading will also be watched. Economists expect March figures to be 0.3 month over month and 3.4% year over year, compared to previous number of 4.4 year over year. So they're now looking at 3.4 versus 4.4. Core CPI. I don't think we're going to get to 3.4. I think we're going to be closer to 4.4. But they're expecting 3.4. They may be disappointed. It'll be interesting to see where it comes out. Initial jobless claims are coming in. They're looking at 228,000. This has been a nothing burger for the year. Don't fall for the banana in the tailpipe there. Europe is looking pretty. They're digesting larger, softer than expected U.S. inflation data while waiting up a raft of important regional economic data, and gains in luxury stocks are leading the overall market higher. In China, that darn China, it's giving me the biggest heartburn. We have a position in the Chinese FXI in one of our programs, and it's giving me nothing but a heartache or heartburn. China's Shanghai Composite closed lower even after data showed the country's exports unexpectedly rebounded in March, snapping a 4-month streak of declines. That's very positive. At the same time, analysts say that the unexpected rise in March exports was unlikely to be maintained amid softer global demand. Very, very true. I just don't see them getting out of this mess this easy. Japan's Nikkei closed higher. Again, optimism in the domestic retail sector outweighed worries about possible U.S. recession, and Warren Buffett saying he's going to be investing in Japan didn't hurt either. Harley-Davidson dropped 4% pre-market. There's going to be volatility to the downside there. The CFO would step down, he says. Merck is up 1% after upgrade from Citi. So watch healthcare stocks. That'll be interesting. And today we have earnings on Progressive, which we are holding, actually. I hardly ever hold positions into earnings, but I decided on this one because it looked really strong. Delta Airlines is reporting, and Bed Bath & Beyond. There's other stocks, but those are the big ones. Now, getting into the nitty-gritty, I wanted to show you momentum levels right now and how they're looking. We still have 100% on energy, which is really, really high. Healthcare is at 94%, but it looks like it's starting to cool off a little bit, I think. Maybe not. Let's take a look here. Oh, let's see here. This is just so overdone right now. Healthcare needs to start coming down. Really, really coming down. I mean, this is grossly overbought. It just doesn't stay here very, very long. So I'm actually looking for healthcare stocks to cool off. There's more vulnerability. For example, utilities too. Utilities have 100%. It's just a little too much. So watch for utilities. watch for energy to cool off just a bit. It's just too much too fast. Most of these are looking okay, except for energy here as well, and for utilities here as well. Both. Look at utilities under a 50-day. They're just a little overdone right now. Look at that. So I'm starting to get a little bearish on the utilities. Now, it doesn't mean it's going to happen today, but I am starting to get a little bearish on the utility sector. And that means bonds may be coming off too, because bonds and utilities are very related. You know why? Because there's always a competition between where to put your interest rates. In utilities for dividend or for bonds for interest rate. So if interest rates go down, bond prices go up, but if interest rates go down, yield is lower, people put their money in utilities. But because bonds and interest rates are inverse, there's a relationship, direct relationship between TLT and bonds, and TLT looked like it peaked out and it's coming down, as you could see here. And I predicted it. We covered a position right here, actually. And I think we may have more downside to go. So be very, 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 very cautious over that. Now, today's Thursday. On Thursday, I always give you my favorite ETF and option pick. And today, you may be a little surprised at what I pick, but I'm going to go with the basic materials sector. Now, let me show you something interesting. Over the last month, basic materials started coming up. It was all the way down. It started coming up. But if you look on a month, you don't have that same thing you have cumulatively. Like, for example, technology is already in fourth place. Consumer discretionaries, they're here. Notice they're becoming fragmented. Now, over time, basic materials is the third spot. And I think it's going to start rising again. It hasn't had a strong 1 month, but it had a really strong 3 month and a really strong 6 months. And I think we're going to start, matter of fact, on a 6 month basis, basic materials is third spot. Now, with technology and communications getting a little heat from bond prices coming down, which means interest rates going higher, I think material is going to start leading. If you don't like material, you can go with industrial. They're very tied, but I like materials right now. And if I was to look at the basic materials, which is XLB ETF right now, which I'm going to look at right now, I will tell you, and I like how it's breaking out here too. It just needs a little bit more and it'll break out. Let me show you the options that I'm liking. Now, the strike prices are the ones I like, but you're going to have to go a little further out in terms of liquidity. It'll pick up as the market opens. There's a lot of open interest and volume. So the spreads will tighten to very, very narrow. It's about 80 right now. I would go with the 82. 81, 82, 83. These three strike prices look really good. If anything, 82, 83, because this one doesn't have any volume. And open interest is on the lower end. But 82 and 83, you're fine. And as soon as the market opens, the spread will tighten. But I do like basic materials quite a bit right now. Now, before I let you go, we sure covered a lot of ground. If you love a bargain hunt, then I have something you don't want to miss. It's going live today at 1 p.m. Eastern Time to reveal a brand new way to trade. It has nothing to do. It has to do with ignoring stocks, share price, and focusing on the options instead. By identifying what I call pricing mismatches, even a tiny 1% move in the stock could lead to a gain as much as 31, 41, even 46%. And it depends on the option. If you go really leveraged, you can go 100%, but I don't play that game. In a matter of days, stop looking at the price of the stock, start looking at the option. Now, once you learn how this information is used to your advantage, you'll never look at the markets the same way again. Click the link below, sign up for my live event at 1 p.m. Eastern Time, and remember, it doesn't cost anything to attend. You could find the link to attend either on the site where you're at right now, the Roger Scott channel site, or you can go to YouTube Wealth Press channel. It's below the video. There's also Telegram channel, which doesn't cost anything. We give some free trades there once in a while. A lot of analysis. I may give a comment after the PPI comes out today. But the point is, subscribe, be tuned in, be plugged into the Roger Scott channel, and Roger Scott, or go to YouTube Wealth Press channel. Roger Scott is on the YouTube Wealth Press channel. You could find this video there. I post them right after I'm done. I'm going to post it right now. It'll probably be there before 8 o'clock, and that's before anyone sees it. So make sure you get Telegram, because I'll push them out as soon as they're done. Like our channel, subscribe, comment, feedback. Talk to you soon. Bye, guys. Have a great, great Thursday. Keep your eye on that bond market. If it goes lower, it's going to put more pressure on the Nasdaq. Bye.